Ben Reppond. Today is November 22, 2023. Welcome to my YouTube broadcast. I begin with a piece, just a theme from last week, what I saw last week. And this came out of yesterday's video that I played, was on Cathie Wood, and she talks about deflation. And I play it because this is a little bit counterintuitive. We are in a period right now of increasing asset prices. Of course, we still have inflation going on to some degree. It may have come down, but on a cumulative basis, it is still going up. It's just going up at a slower rate, but it's still a period of inflation. And we have stock market prices, bond market prices elevating. So for someone to talk about deflation seems counterintuitive, kind of the lone voice out there that's talking about this. And so I played it yesterday. I'll play it again right now, just to say this is, if you want to kind of look through all the noise into the future and say what's probably coming next in, let's say 6 months, sometime in 2024, what's coming next, I think this is correct. I think she's correct. And that and she makes a case for it of why she believes asset prices are coming down, which would be things as much as commodities, that things that we buy, goods that we buy, commodities, as well as, I'll add to it, stocks and bonds usually follow that. So take a listen to this. Cathie Wood, the CEO of ARK Invest, who is making the case for deflationary period in front of us.
Obviously, CPI, you saw it cool across the board in October, both on headline and on core. And to say the least, the market reaction has been pretty swift. Curious to hear your thoughts, though. When you think about what this means for the Fed, is it safe to say that we've seen the last Fed rate hike of this cycle?
First of all, I'll say I agree with almost everything Ken Griffin just said, except his comments about the Fed. For some time now, we've been saying that the Fed has overdone it and that the greater risk here is deflation. Yes, the CPI did not surprise us at all, although there were rumors that revisions would take it higher than many people thought. And so we believe we're beginning to see deflationary trends in many more sectors now. It started with commodities. Now we're seeing airline prices coming down, auto prices coming down, and we're seeing staples prices. They have been sticky, but what's happened to staples volumes? They have gone down. That's not how you run manufacturing plants. So we think that they will be forced into cutting prices as well. You heard Home Depot today, negative 3.8% comp store sales here in the United States. And if you look at the S&P 500, I think a third of all companies in the S&P 500 are reporting negative revenue growth. What we have characterized the last 2 years as a rolling recession. Some measures of housing are down 40%. That's a recession. Autos, 15 million units in the U.S., that's kind of punk. It's recession-like. And we're seeing these volume declines in staples. Right. You've got consumers pulling back. So I think the Fed's overdone it. I think we're going to see a lot more deflation going forward. We are going to hit that 2 handle, and we will go below it, and would not be surprised to see CPI inflation negative at some point next year.
Now I want to jump into the dashboards, 2 of them. This one is the 6 equity indexes. The top 6 are equity indexes, and the last one is the 20-year government bond. So as you can see, in the yellow box, this is last week. Last week was a good week. It was really good for equities, and it was good for bonds. So glad to report that. The one thing that does stand out, 2 things that stand out, is bonds finally are starting to go up a little bit. So they've come down a long, long ways, but I'll show you that later. But it's positive to show that bonds had a positive week. But the biggest news of last week was the 6th line down is the Russell 2000 Small Cap Index Fund, IWM, had a gain last week of 5%, outstripping everything, way outstripping even the technology-heavy NASDAQ 100, which went up 2%. So that probably adds to the breadth in the market and positive. In the pink box is the year-to-date numbers, and two of them definitely dominate, especially the NASDAQ 100, and then to some extent the S&P 500. From there, others are positive. The Dow, of course, the Russell, and the emerging markets and developed markets. Look at onto the far, and then bonds are still negative by 9% for the year. To the far right, look at how many are above their 20, 50, 100, and 200-day moving averages. A lot. And it's just the small cap and the bonds that have anything below, and they are only below their 100 and 200-day moving averages. Everything else is positive. So this is an upbeat period, time to be invested. We got invested, we were out of the market during that decline that went from the end of July to the end of October. We were out a good portion of that time and avoiding quite a bit of that loss, and then got back into the market on the fourth day that the market started back up. We missed the first 3 days, but that fourth day we got in and have been in ever since. And I think of it kind of metaphorically like we are riding the wave. And so as long as this wave continues, we're going to stay invested. When it doesn't, we'll be looking for a place to exit. So we want to take advantage of this as long as we can. So a very positive report. Next, when you take the S&P 500 and you break it down to its 11 sectors, you would see that these 11 sectors going top to bottom, there are a lot of green dots. There are, out of the 44 potential, 29 are green or positive. They're above those moving averages, the 20, 50, 100, and 200-day moving average. However, there are a number of sectors, energy being one that's below all four moving averages, and then there are some other sectors that are below in some instances. But by and large, when you look particularly at the top half of the chart, you'd say, a lot of those are very positive. Technology and consumer discretionary by far being the most positive on a year-to-date basis. But as you look below that, in the pink box, you look below that and you go from 2.96 down to 6.79% negative. So those are 5 sectors, even year-to-date, even now after this week, 6 sectors that are still negative on a year-to-date basis. This is the S&P 500 for the last 18 months, and you will see that it's gone up and down, but by and large, it's gone up. So the last 3 weeks, which I just talked about, is on the far right of the chart. You can see that as it's extended upward, and that's where we are. It is basically pushing up from here, and we're enjoying being in positive territory, and it's good for our model, which is actively managed, and it's good for buy and hold investors as well. Those who are in the market, it's good for them. When we look at the S&P 500, we have growth stocks and we have value stocks, 2 very different kinds of stocks. One focused more on earnings, one focused more on revenue. And when this is a relative strength chart, so when this goes up, this favors growth. When it goes down, it favors value. So you can see from the beginning of the year, it's generally speaking gone up, which has favored growth. But when it goes down, as it did this last week, when it goes down, it has more it favors value more than growth. So some of both. But this says that in the short run, value is starting to come into favor, but over the intermediate term, period, almost a year, it is favoring growth. This is a relative strength chart showing the S&P 500 relative to the small cap index, the Russell 2000. Now, I just talked about the Russell 2000 doing so well this past week, and you can see that on this chart relative to large companies, small companies. When it goes up, it favors large companies, the S&P 500, the 500 largest companies on the NASDAQ, or on the stock exchange. When it comes down, it favors small cap. So you can see from the far right of the chart where it comes down sharply, and that was that spike up in small cap stocks this past week. But since March, it's mostly favored large cap. Okay, government bonds. This is getting away from the relative strength over to an absolute chart. And you can see that generally speaking, over the last 42 months, that bonds, the long-term government bond in this case, has come down, down and down and down, making attempts to go up and then just collapsing. In the last 3 weeks or so, you can see at the very bottom there is a tick up, and that shows that bonds are starting to rise in value, which means that bond yields are dropping in value, or they're anticipated to drop in value. And that usually corresponds to interest rates as well. Is that going to continue? It's still below its 20-period moving average. I don't know. It's been a long ride down, and maybe if I were to guess, I would guess it's probably going to go on up from here, but I don't know that for sure. But that would assume that interest rates are going down, bond yields are going to go down, and the bond prices would go up. That would be the assumption behind my statement. Okay, the dollar is short term is starting to come back down, and I'm going to show you in a minute that gold is going up, and but I didn't put an arrow on here because there's several places I could say that are going up or down, so I didn't want to do that because it's going all over the place. But in the short run, dollar is pulled back some. Intermediate term, it's gone up some. So I'll just leave it at that. Gold had a good week. It went up, as you can see on the far right of the chart. So it's not only up for the week, but when I go back to October of last year, so this is about a year, gold has generally speaking been going up. And same with silver. Silver is a little more volatile, goes up and down more radically, but it had an even better week than gold did, and went up, and you can see that sharp rise at the far right of the chart. And since last October, also a rise in the price of silver. When I put them on a relative strength chart, then this goes up and down a lot. So I don't know that there's a lot you can tell from this other than the fact that it goes up and down a lot. When it goes up, that favors silver being stronger than gold. When it goes down, it favors gold being stronger than silver. And because silver had a better week last week than gold did, you can see the move up at the far right of the chart. But over the past 18 months, it's mostly up and down a lot. Bitcoin pulled back this last week, and it's had a nice run up. We participated in that. And then at the very top up there, we got, or after the brief pullback, we got out, and then we got back in. So we're back in Bitcoin now. And so, but we've definitely made some money in our Bitcoin strategy. This goes from November to November. So over that period of time, both the short term and the 12-month period Bitcoin has been going up. Volatility this last week, because the S&P went up, all of the stocks and indexes, most of them were positive. You can see that, I think on the very first chart, you could see the indexes, and the second chart, the sectors for this last week, it was all positive. So as a result, what happened is that the volatility index went down. So when the volatility index goes up, that shows higher volatility or risk entering the market, and vice versa. When it goes down, it shows reduced volatility in the market, and usually increasing in stock prices. That's exactly what happened. I put my mark on the 24 so you could see the arbitrary mark of when I consider that things are moving into a more dangerous zone, typically. That's the number that I choose to use. We're quite a ways away from that. Asberry Research, they've got the Asberry 6. This shows that of their 6 indicators, they are all positive. When you look at all of the data that I've given you, no surprise. Everything is in a positive direction. And by the way, last week, everything was also positive. Gold and silver. As of last Friday, from the previous week, gold, the spot price of gold was $19.85, which is an increase of 2.2%, matching what I just showed you in the previous chart. Silver is $23.75 spot price, which is an increase of 6.5% from the previous week. This has a gold ratio of 87:1. A monster box of silver, this is 500 rounds of generic silver, is $13,040. This includes a $2.28 markup over spot. So for a round of, for 500 rounds, per round, that's $26.03, including the markup. When you break it down to a tube of 20, the price is 50 cents higher, $26.53 for a tube of 20, including the markup. Source of this is from my son Preston at the prices that he sells them at. But it gives you a point of reference. If you're buying them and you want to buy local or have someone you prefer to buy them from, this gives you a benchmark for what's out there in prices. Well, thank you for watching. If you have questions or comments, leave them in the comment section below. Thanks.